All right, so today we're going to talk a little bit about the trading and investing rules and go on to a little bit about behavioral stuff. Behavioral research has become important over the last decade or so as people have come increasingly to recognize that a lot of the paradigms that we observe in day-to-day behavior amongst investors, professional investors, individual investors, all kinds of people, among others, do not follow standard financial models that we have long believed and accepted for most of the 50s, 60s, 70s, 80s, 90s, and 2000s, and so on for the last 50 years, that there's more going on. There seems to be more going on. Now, what is interesting is that one of the Nobel Prize winners this year, or this past year, was a guy called Eugene Fama, who's well known for his market efficiency idea, which we'll talk about briefly today, who continues to deny that there's anything behavioral going on at all. He's been very vociferous about this in the literature. He's a professor at the University of Chicago, has spent most of his life, all of his life pretty much there. And the market efficiency stuff that we're going to talk about, that was his brainchild in the 70s. He did this work in the 70s, about 40 years ago. He continues to stand by, which is not surprising because that's his life's work. For him to now do a mea culpa and say, oh, guess what, I don't think that's quite correct, probably is, takes, well, let's put it this way, he's not there. And so he continues to argue vehemently against any kind of behavioral stuff, that there is anything going on unusual. He thinks that those are just anomalies. There's nothing systematic going on there. And so I wanted to add that it's not, what we talk about today is not universally accepted. It is accepted by a lot of people, but there are clearly detractors to this idea, people who believe that all of this behavioral stuff is nonsense, and all of that can be explained as anomalies, that they're simply behavioral aberrations, right? I mean, take the case of the tragic incident we had at Purdue 3 weeks ago, whatever, when one TA, shot another TA, a fellow TA. Does that define our behavior? No, it doesn't. But there are aberrations that happen tragically and take lives and things like that, but that does not explain who we are. And that's the same idea here, that there are aberrations, these behavioral stuff that we see are aberrations, and does not generally explain things as we know them to be. And so that's sort of the same idea. And so this economist in question, the father of this efficient market stuff, continues to insist that everything we see that seem to deviate from this rational idea that everybody behaves rationally, is really an anomaly. It does not explain the mainstream of ideas. And so wanted to leave it out there. All right, so we've talked about this idea about the difference between trading and investing. And we've talked about the fact that trading refers to a shorter investment horizon, where you are relatively quickly buying and selling things. And in those kind of situations, it's not so much the fundamentals of the stock or the company in question that you're interested in, but more the trading characteristics, volume, price behavior, volatility. Those are kind of things that you worry about when you are in short market timing mode, that you want to buy something or sell something and quickly buy it back. Quickly can be anything from a few seconds to a few minutes, maybe an hour, for us. For an institutional investor, of course, quick might mean a nanosecond. You buy and sell immediately, but obviously you're not doing it through human intervention. You have computer algorithms set up, in which case, a nanosecond is still a discrete time interval, and you can work on those scale. But so this is sort of loosely defined for us individual investors. I'm not talking algorithms, computer algos, and things like that. But for us, as normal, breathing human beings, individual investors, some of these common sense trading rules are, when you're in the trading mode, take a look at the 52-week high rule. So if a stock currently is trading at or near its 52-week high, it's probably best not to buy those things. You can short them because statistically, not statistically, but the data has shown that these 52-week high mark points represent some kind of a ceiling, if you will, on stock behavior, that it's kind of difficult for them to break through those 52-week high barriers and reach another level. And therefore, if a stock is currently trading at or near its 52-week high, previous 52-week high price, then it's better not to buy that stock at this point. You might want to think about shorting that stock because the chances are more likely, it's more likely that the price will go down than go up in the near term. So when I say don't touch, I mean don't touch in terms of buying something. If you want to short it, of course, then that's something you may want to consider. The million share rule is simply a liquidity rule. It simply says that if you look at a trading volume of a particular stock and you see that its average daily trading volume is about 25,000 shares or 50,000 shares, it's probably a risky play. It's probably a risky bet for you to get involved in that kind of a stock. Unless you happen to be an experienced investor, you've played this game, you understand how markets work, you can take it on. But for the most of us who may be relatively new or a novice at this game, it's better to look at volumes of stocks which have high trading volumes, daily trading volumes, and somewhat a million share daily trading volume, somewhat arbitrarily chosen, but the idea is you need liquidity in the stocks that you trade in, and try to be in stocks that have high liquidity, in other words, high trading volume. Then avoid small and mid-cap stocks. This just follows from what we've talked about in terms of risk. Small cap and mid-cap stocks are basically riskier than large cap stocks, and we've talked about, basically concentrating your attention mostly on stocks with market caps greater than $5 billion, and we can see that clearly from the opening in page, the summary page of any stock, both under Google or Yahoo or any of these other places, and you can eliminate those. And then the analyst consensus rule is basically look at what the analysts are saying as consensus, as a group. As a group, what are the analysts saying? And if the trend is towards one, it's moving towards one over time, then that's a nice piece of information to have up your arsenal in terms of trading decisions. Again, this is assuming, all this is assuming that you're on the buy side of the market, right? So you might want to, the liquidity part will hold whether you are on the buy or sell side, but certainly the 52-week high, even the small and mid cap, the volume related rules, the million share, the 2 and 3, points 2 and 3, are independent of whether you want to be on the buy or sell side. That's you just want to be on the liquid side of the market and low risk. So 2 and 3 are directionally independent. Whether you're buying or selling, those two rules apply. 1 and 4 certainly are looking at, even the analyst 4 is more, I'm trying to say that if you're on the buy side of the market, then go for something that's closer to 1. If you're 52-week high, don't buy anything that's closer to its 52-week high. But if you're trying to sell or short sell something, then those two will clearly work. What is good for buying, bad for buying is good for short selling. So, and then, did I miss the, Michael?
I can't see the screen. Oh.
That's it, right? Number 4.
Yeah.
That's all I have?
Yeah.
Okay. All right. And so now you can verify these rules. Can you pull up those screens? We'll just pull up one. BlackBerry. So you can see that some of these, the price ranges, so we talk about those, right? The 52-week price. So look at that. The 52-week price has been between $5 and $17 roughly, last 52-week BlackBerry. And you sort of are familiar with BlackBerries. I mean, this is a very tragic story, bordering on the likes of Kodak, right? I mean, similar kind of very sad story. This company clearly had the first mover advantage, name recognition, business users, use BlackBerry. I mean, that was like a monopoly almost, I too had a BlackBerry. My first smartphone was a BlackBerry years ago. And so, and from there, they're in ruins today. I mean, this company is pretty much out, and the founders are now trying to buy it back and just restart, basically. And this is a company that refused to see the writing on the wall, refused to adapt, and just went under very, very quickly. So this is a company. Now, would I buy this company as a risky play? Well, look at the price currently. It's at 984. The last 52 weeks, it's been between 5 and 17. So it's roughly at the halfway point between, or a little less than the halfway point to where it has been. So from that standpoint, it does pass muster, that this is something that I might consider buying. Look at the volume. The volume is certainly, let's see, average volume is what, 30.6 million average daily volume. Yeah, so there's clearly a high volume stock. Market cap barely above, so it's 5.1, so meets that test as well. So this is certainly a company that you may think about buying, might want to look at it for a while, see what the gyrations are, daily price movements are. But this would certainly be a play. It'd be somewhat of a risky play, but it's still worth considering this as a potential investment opportunity at this point. Maybe there's a little bit more, it'll come down, but beta is 1.7, so it's risky, 53% institutionally owned. It really is, earnings per share is in the negative territory, not surprising. It's in bankruptcy right now, pretty much. So this could be something that you can consider as a risky play. If you're new to this, I would say stay away from it. This has got too many negative things going on. It's just very volatile right now. The stock, we don't know. It's really, but in terms of the parameters, you can see that all of the markers I gave work out favorably to this being a buy play. But I'll leave it to your judgment on that. But this is, if you're relatively new, you're not very sure of what you're doing, I would avoid this. But if you are beyond that stage, this might be something you may watch for a while to see what's going on before taking a position on it. But okay, moving on. Okay, so let's just move on. Okay, I'll just move on. Yeah. So with investing, so we've talked about trading. Investing is more of a longer term horizon thing, as we talked about. So investment, you are okay. Okay, so when we talk about investing, you want to look at price earnings ratios. Okay, and so forward price earnings ratios are nothing but where the earnings is expected earnings. So when you look at a price earnings as a forward-looking measure rather than a backward-looking measure, you use what is called a forward PE ratio, where the earnings in the denominator of that ratio is nothing but expected earnings, expected future earnings. So analysts come up with those future earnings. What is the expected price 1 year from now? You use that in the denominator. And therefore, that gives you a forward-looking measure of price-earnings ratio, which is different than a trailing PE ratio, where you actually use the earnings, the actual earnings over the previous 52 weeks, which is the backward-looking measure. So make sure you understand the difference. The forward PE ratio looks at expected earnings as a forward-looking measure of PE, and the trailing PE looks at the earnings that have already been realized the previous 52 weeks. And so that's more of a backward-looking measure. Professional investors generally prefer the forward measure, the forward PE ratio. And so all this is telling you, when I say forward PE is less than trailing PE, means that the earnings, that your expected earnings are meant to grow. If you have expected earnings that are greater than what has been realized, you'll see a simple thought process will tell you that the forward PE has to be less than the trailing PE. Only when the expected earnings are greater than the earnings that have already been realized. And that's what you need for a company to show, is that there's a growth pattern in earnings, and the expected earnings are higher than what's been realized. So use that as a way to, as a metric. And then the trailing income pattern rule. Is the company making profits? I mean, that's a very fundamental question to ask. No, sometimes, a very good example is Amazon, which kind of defies everybody because they don't make profits. They lose money most of the time, most quarters, or make very little in earnings, but the market loves it. The street loves it. So again, there are a few exceptions, but for the most part, you want the company that you want to take position in to make profits and to show a pattern of making profits, right? So from year to year, you can look at the last 3 years and make sure that this company has been making profits, and there's an increasing pattern to the profits, that they're making increasingly greater profits. Again, as I said, there are exceptions to the rule, Amazon being a very good example of exception, but that's an exception. I mean, there aren't too many Amazons in the market, and they have a business model that for some reason Wall Street loves. And I love the company. I'm not a shareholder of the company, but I love the company. It's a great company, gives us great value in books and free shipping, and pretty much they'll come and deliver the book to your home pretty much, at the rate at which they're going. They'll have a valet service and free delivery to your house the same day. What's not to like? So as a consumer, I love it. I love the company. As an investor of the same company, I don't know if I'll feel the same way. So it's a different mindset. But and then insider activity rule. What are the insiders doing? In terms of insiders means corporate insiders. So these are senior people in the company, and you can actually look it up. Every company, publicly traded company, has a list of insiders, what the insiders are doing. Say if the insiders are lining up to buy or sell company shares, that might give you some added indication of what these people think, even though most of the times the insiders will give some kind of innocent sounding explanation of why they're doing what they're doing. If you see a lot of people lining up on one side or the other at one time, that might give you some added information or insight as to what might be happening in the company. So insider activity is certainly something you want, and if it's a company you're thinking of buying, you would also like to see ideally that insiders are also lining up to buy rather than sell. In other words, the net trading activity of insiders should be on the buy side if you are contemplating buying. And of course, if you're thinking of selling, then you want, you'd like to see confirmation as a net sell kind of from insiders. So, okay. So, and then I did tell you, okay. So the next part is selling. So selling is a more difficult decision than buying. Buying, you can more or less rationally couch it to with all these markers that we've talked about. You may quibble with some of them, that's fine. But for the most part, we have a lot of rules in place that we can employ to decide when to buy. Selling becomes more of an emotional decision. Selling anything, selling whatever it is. It doesn't have to be stocks. It could be a relationship. Not selling literally, but giving up on a relationship. Those things become very important. I mean, a lot of psychology gets entangled in the decision, and so one way out. That in fact, this is exactly what led to the popularity of algos as a trading way for institutions. Is precisely that you take the emotion out of the selling. And so algorithmic trades, or algos as they're called, are precisely that you write a bunch of computer programs and let computers deal with when you want to sell. So as long as you program in what the market conditions are, or the stock condition has to be for the sell algorithm to go into practice and sell you out, then you've taken the human part out of it altogether, and you're letting computers handle the whole decision. And that's what institutions do for the most part. They have all these algos that have been written that deal with it, that you just fiddle around with the parameters you want, and then if market drops 10% or whatever, the stock itself drops 10% or more in a day, whatever, you sell. And so, or it could be some other combination, but these are predefined rules, and you just automate them through a computer program. So here's some examples. You can see sell stock if price drops $2 below its purchase price. I mean, you can practice that, and for the stock challenge game that we'll have starting soon, you can actually practice these kind of selling rules that you predefine and then follow. So all that the institutions are doing they're writing computer programs to do these, but as long as you as individual investors, as us, we have these predefined rules in place, then we can do the same things. We don't need a computer program to do it for us, as long as the goal is that once you have a predefined rule in place, you've got to execute that. You cannot then back out and say, maybe next time. So that's the key. And that's where computer programs come in handy, because there is no emotion involved. Once you program in, it's as good as done. So, so that's sort of the, in terms of selling, as best as you can, make the process like a computer situation, a computer programming algo situation, where you have predefined criteria in place and you simply follow those without the emotional entanglement. All right, so now stocks shopping. Shopping for stocks is one of the things about stock shopping that has been in place for over 200 years, is that you and I cannot walk into an exchange and directly transact in stocks. This is one of the things that the founding fathers of the modern stock exchange, especially in the US, in 1792, the Buttonwood Tree, the famous Buttonwood Tree where the New York Stock Exchange stands currently, what they did was these 20 people who were the founders of the original stock market in the 18th century, they decided that we are going to be the gatekeepers, or we or our successors through the next, whatever downtime. It's going to be we are going to be these gatekeepers to the exchange. And so individual people cannot just walk in and out and trade. You have to trade through these people who are the gatekeepers, the brokers, if you will. And so then that's the convention that is followed throughout the world now. And so the brokers, in order to instruct the brokers into what you want done, whether it's buying or selling, you have to have some standardized instructions that cannot be misconstrued. Right? So the idea is to make the decision of buying and selling as vanilla and as routine as you can, so that there is no room for any misunderstanding as to what you implied when you instructed your broker whether to buy or sell something. And these standardized instructions take the form of these order types. Market orders being the simplest, then you have limit orders and so on, stop loss orders and so on. So that's basically the reason why we have these order types, is to standardize instructions between us as customers and the broker, the intermediary that we transact through. For most of us, when we do these things now, it's through an online brokerage system. You all have people who are seriously doing this stuff, and I know quite a few of you in this class do that currently. You have these online brokerage accounts, and you go in and you want to buy or sell, you click in, you say how many shares and all that, and we'll discuss that in a second, and the job is done, and you get your execution report and all that. So it's basically, this idea is to standardize the instruction. And so market order is the simplest order that you can place. And all that it tells you, all that you need to instruct under a market order is how many, what's the ticker of the share you want bought or sold, how many shares you want, and that's it, ticker and the size. Let's say 100 shares. You want 100 shares of whatever, Facebook, FB. So you put in the ticker FB and you say buy or sell. You check that drop-down box, buy, ticker, and then you put in the quantity. That's it, and you're done. And you put in a execute or whatever, it'll ask for a confirmation, and you do that, you repeat the and you say yes, you meant what you said, it was not an accident, and then it'll get executed. That's it. And that's how market orders work, whether you want to buy or sell. All you need is a ticker, the quantity, and whether it's a buy or a sell order. So under a market order, the transaction is certain. You're going to have a transaction, right, for sure. When you place a market order, you're going to get transaction certainty. That means it's going to transact. The question is, at what price? You haven't specified the price. You've simply said, you've left that unsaid deliberately. That's part of the market order, is that it'll execute immediately at the best possible price that it can find. The best possible price, which means if you're on the buy side, it'll buy you as low as possible. If you're on the sell side, it'll sell your stock at the highest possible price it can get at that point, at that next instant. So that's your market order. So there is transaction certainty, but not price certainty. It's price uncertain, transaction certain. Limit order, however, takes it a little further up this level of complexity. It's a little bit more complex. So limit order is where you have to now specify both the quantity and the price. So in a market order, you basically specified the quantity, how much. Of course, the buy-sell, you have to tell them whether you want to buy or sell. But for the purposes of this discussion, market order was where you left the price unspecified, but you specified the quantity. In a limit order, you specify both the price and the quantity. So it's one level higher in the scale of complexity. If it's a limit buy order, for example, you will say 100 shares at this price. You will click a price. You'll choose a price. And if it's a buy order, that means that price or lower. That price or lower. That's the implication. Obviously, if you're willing to pay $50, you would be more than happy if your execution were below $50 because you'd be paying less than what you intended to pay. And on the other hand, if it's a sell order, then it's the price that you limit sell price that you specify is that price is the minimum price that you will accept. In other words, if it's sold for a higher price than that, then you're happy. It's not a problem. So, and then of course, you can choose from two other choices. One is good till canceled. So when you place a limit order, you have to choose whether it's good till canceled or good for the day. Good till canceled simply means that it will try to find a price for you to sell within what you've specified, the price that you've wanted. And if it cannot, then if you've specified good till canceled, it's going to stay in the books and it's going to try the process till you physically cancel the order. Whereas if it's good for the day, then it'll try for the rest of the day, and then if it doesn't work, if it doesn't execute by the end of the day, it'll cancel itself out automatically, and you don't have to worry about it. Now, why are we talking about this lack of execution? When you specify a price, you have pretty much said, it's a conditional order. You have said, oh, I will buy or sell only if my price condition is met, that limit price that I've set. And if that condition somehow is not met because the market moves away from that price right after you set the order, and doesn't get back to it, then the order will hang, and it will not execute. And then you can let it hang there till such day that the market might come back to it, because dips happen, and the markets gyrate all over, and so it can come back to it, or maybe not. And so that's why there is a possibility that when you place a limit order, that it may not transact. You may not get execution. But if it does execute, then you get the price pretty much, or close to the price that you wanted, whether it's a buy or a sell order. So the trade-off now between a market order and a limit order is the market order or the limit order is that, I'm just trying to get this thing to, in market order it is transaction certain, price uncertain. In a limit order it is price certain, but transaction uncertain. Okay, so that's the trade-off between those two types of orders, is that if a market order will execute for sure, you will get certain execution, you just don't know at what price exactly. You can guess, depending on what kind of market you're in, you can guess it, but you won't know for certain till you get that confirmation report back as to exactly what price you got. With a limit order, however, you will pretty much, you've specified the price, so there's no surprise there. It's going to be that or better if it executes, but there's no guarantee it'll execute. So that's sort of the trade-off between the two. So you have more control. As orders go, you have more control with a limit order than a market order. So if you are a trader who knows his stuff, his or her stuff, and you know exactly where you're getting in or out, you place a limit order. You simply place a limit order and have it execute under your conditions that you've set versus a market order. If you want something done quickly, you use a market order and you get it in and out quickly. Stop loss order is another order that I encourage students to play with, especially when you are learning this stuff and you are playing our investment challenge game. Stop loss order is a good order to play with, and the reason is stop loss order is a defensive order, if you will. So as the name suggests, it stops your loss or it limits your loss. How do you apply it? Well, for example, so let's use an example. So let's say you've bought a particular stock, whatever, stock X at $10 a share. Stock X, since you bought, has gone up to 14. Let's say it's trading at $14 or $15 a share. So you've got a paper gain of about $5 a share that you're sitting on. Now, your concern your stress point at this point is to think, okay, what happens if one day there's a bloodbath in the market and I'm in class, I didn't have time, and by the time I get out of class and I check my stock again, it's now trading at $8 a share. There's a whole horrible thing in the market, something happened, and all shares went down, most shares went down. The share all this paper gains I was sitting on in this particular share also evaporated in a few minutes, and we're now back down to $8 a share. And it was on 14 when I went to class and come out of, okay, I'm being a little dramatic, but it has happened in the past. Things happen, not very frequently, but it can happen. The moral of the story here is that how do you prevent how do you put an order in that will somehow limit the losses you can make? And answer is a stop loss order. So let's say, in this particular example that I just gave you, you bought it at 10, it's currently, say, around 15. It's trading at 15. You're worrying that the one bad move in the market can wipe out most of those gains and leave you with nothing. So what you do is you place a stop loss order, let's say at $13.50 or $14 a share. Now what happens is once you place a stop loss order at 14, what it'll do is it'll stay dormant in the system, and then if for whatever reason the share price comes down, drops, and touches 14 from 15, let's say it comes down and hits 14, the moment it hits 14, it will activate and make itself a market order and then sell you out as quickly as possible at that point, around that price. So what has it done? It preserved your at least a $4 a share gain that you had. So it didn't, and let's say by the time you get out of class in the same made up example, let's say now it's trading at $12 a share. So in 50 minutes it dropped $3 a share. Now since you had a limit order, a stop loss order in place, it sold you out at 14. So you still kept your $4 gain, whereas if you hadn't placed that and you came out of class and you checked your price, it was at $11.50 or $12 a share. So you'd be in far worse shape. Even if you had sold it at that point, you'd just capture $2 in gain, whereas in the stop loss example, it sold you out way before while you were in class without your active intervention, and you managed to preserve $4 of gain, okay, per share. So it preserved. So you stopped or minimized your loss in that situation, and that's why people use it. But if it doesn't hit that point, so the other example is, let's say you put it at 14, and it never hits 14. It comes down to 13.70, 13.50, 13.25, 13.20, but then shoots back up and doesn't hit 14.20, doesn't hit 14, and it goes way back up. Then you're fine. Your order never activates, and you continue to capture gains. So the big advantage of a stop loss order is that it protects the downside without affecting the upside. So if the stock were to come down, then it will sell you out and preserve whatever, most of the gains that you had made. But if it doesn't, then you continue to enjoy holding that stock and making more money out of it. Okay, so that's now the big question here is that where do you set that point? Where do you set the stop loss point? And that there is no hard and fast rule for it. It depends how much risk you're willing to take. If you are a risk-loving person or relatively low on the risk aversion scale, then you may place it relatively further off from the market, right? So the closer you are to the current price, the greater the chances that you'll be sold out, because stock price does move up and down. There's a lot of volatility usually, in some of these stocks, and so if you keep your stop loss price close enough to the current price, you can get prematurely sold out. But that may be okay with you because you're a risk-averse person and you don't like taking a whole lot of risk. But if you're not, then you may want to keep that price, the stop loss price, slightly away from the market so that it's going to hit that only if certain major things happen. Otherwise, it's not going to hit that. So where you place that is entirely up to you, and there is no right or wrong answer. It's how much risk you're willing to be taking and be comfortable with. That's what drives that choice of that price. Having said that, the other point is that you can also, it doesn't have to be that, it doesn't have to be that once you set the price, it's done. No, you're not going to be charged till that order executes. So you can actually, let's say you place it at 14 initially when the price is at 15, but a few days later the price has gone up to 16. Well, you can move that, you can cancel the original order and then move the stop price up at 1450 or 1475, 15, whatever you're comfortable with. So you can keep playing with that price point up and down depending on what's happening to that stock. And until that executes, you're not going to be charged anything. So you can freely cancel that order, reissue the order, whatever you want, and you're fine. So you can continue to play with that price point to suit your comfort level. Now that's a big advantage. Now, what's the big difference between limit and stop loss orders, right? That's sort of the big question. So what is a limit sell order? Limit sell order is where you place a limit. So limit sell orders are typically placed above the current price. So let's say stock is trading at $15 or whatever. You place a limit sell order at some price above that price, right? Above that current price, whatever that price is. And so the idea is that once you place a limit sell order and price goes up and hits that point, it sells you out. You're out of the market at that price. Right? And so, so notice the difference immediately. The one difference between stop loss and limit sell is that stop loss is typically placed below the current price. Limit sell order is placed typically above the current price. Right? So think about that for a second. Think about that for a second. Limit sell order is placed above the current market price, whereas a stop loss is placed below the current market price. All right? So this is the thought question we had. So when would you place a stop loss versus a limit sell order? Right? When would you do one versus the other? Because think about what a limit sell can accomplish for you versus, and what it may not, more importantly, that a stop loss order can. Right? Think about that for a second. It's a really a non-trivial exercise. Because a lot of people say, oh, well, I can place a limit sell order almost as a substitute. It's not. They're serving two very different purposes. When you place a limit sell order, you are looking for something very different than when you place a stop loss order. Okay? What is that? If you can think through that, that'll be a... In the meantime, I'll look at some of this other stuff here.
Sending to screen.
Oh, okay, sending to screen. And it disappeared. So I'm going to selectively answer some of these because a lot of these I've already sort of responded to in my discussion of these trade-offs. Does a stop loss guarantee a sellout at the price you specified? That's a very good question, actually. Does it guarantee the price? No. And the reason it doesn't is because it depends on how quickly the price falls. So what it does do is that when that particular price you've specified is hit, it immediately becomes active order and a market order at that price. However, it may not be if the price is precipitously, if the market is dropping very, very quickly and it blows through that price and goes below, then obviously the price you may get will be below that. How much below will depend on what the market conditions are. It's going to try, just like a market order, it becomes a market order at that instant. And then it'll try to find the best possible price as quickly as possible to sell you out. Now, it could well be that the price you end up getting, depending on market conditions, could be lower than what you specified. That's possible. So it's a very good question. Can you stop a stop loss order from becoming a market? Yes, you don't have to stop. There are ways to. So what I didn't want to talk about, but of course this question now forces me to talk about it, is that there are different kinds of stop loss order. There is the stop loss, the most common garden variety stop loss is where it becomes a market order when the price is hit. There is also a kind of stop loss order which is a little bit more esoteric and professional investors use it, is where your stop loss becomes a limit order. Okay, when that price is hit. Now there, of course, then you're triggering a whole different set of conditions and the price condition has to be met. So for example, in the example that I just gave you where the price just blew through the price you set and it just went below, if you place the other kind of limit stop loss order where it became a limit sell, then it will not execute because it couldn't find that price that you specified because it went through too quickly for it to. And so in that case, that order will not execute. But in the former kind of the most garden variety type of stop loss order, where it becomes a market order, then it will sell you out at a lower price. Okay. In a market, how does a broker know if the stock is at the best? It's all computerized. When you look at the brokers are also, the markets have gotten too fast and too big for individuals now to keep track in their heads what the best price is. This is all done by computers now. So it's the computer matching algorithm that's looking at it. Price, time, priority, they're following all kinds of internal rules, and so that no individual is sitting there and saying, check, check, check. That used to happen like 70 years ago when markets were smaller and things happened all on paper. Now these kind of things are done by computers. So all right, let's screen down. In the stock market game, are we trading? Can you go down? Okay, what about the thought question? So where are we on the thought question? Limit is playing offense, stop loss playing defense, agreed. But the stop loss on high risk and limit sell on lower, stop loss on high risk and limit sell on lower risk stock. Why would you, what would be your thinking there? Kind of, who posted that answer? Are you willing to acknowledge and explain that answer? I'm curious about it. Just wanted to hear what your thoughts are. Okay. I guess the answer is no. All right. Well, good. You've been thinking about it. That's good. So here's my take on it. So when you have a limit sell order, so what is that? Remember, there's one point I touched on when I said when you place a stop loss order, you are protected on the protected. It's like an insurance policy, if you will. Think of it as an insurance. Okay, stock insurance, where you are insuring, for the most part, the amount that you will get if price does fall, right? You're not gonna lose everything. You're gonna keep the amount of your price, or near about the price that you've set, which is usually below the current price. But if price goes up, you are in the market. You keep your stock, and you continue to get more capital gains. When you place a limit sell order, however, you are above the current price, and if that price, if the stock price goes up and hits that point, you are sold out. Fine, you get some gains and you get the price you wanted. But what if the stock continues to go up and reaches another $10 beyond what you did? So you lost out potentially on all that potential gain because you sold out. You're out of the market, which means you don't get to participate in that stock's increase in price anymore, right? So depending on what it is that's important to you, if you are risk averse to the point where look, I mean, why do we buy insurance? Think about it. Why do we buy insurance? Right? Homeowners insurance. Let's something we are all familiar with, either directly or through our parents or watching. Homeowners insurance, right? Why do we buy it? We buy to protect the bottom line, not the top line. We want our house price to go sky high, right? Because we want to sit on a huge, great investment. We want to feel good about it. We want to make some money if we sold that house. So we don't put a limit sell on our property, but we do buy insurance, like a stop loss. Right? If something bad happens, and if it's within the parameters of the insurance policy, then we get reimbursed for it. But if the price of the house skyrockets, hey, great, right? So it's the same idea when you are buying a stop loss, or when you're putting a stop loss, it's like think of yourself as putting an insurance, buying an insurance on your investment. Right? It's an insurance policy. So if the stock goes up in price, great, more power to us, right? But in a limit sell, that's precisely when you'll be out of the market. You'll be sold out. So it depends on what it is you're looking for. I mean, if you really want to get out, and for whatever reason you've decided that, my money is better spent elsewhere, I'm going to capture this gain, I'm going to buy it at X price, it goes up $5 more, I'm going to take that, sell out, take my money out, and put it elsewhere. That's what typically people do. Like you have X amount of money to invest, and you're just moving it from A to B to C to D. Then it makes perfect sense to have a limit sell strategy. You buy, you capture some quick gains. Let's say you follow momentum strategy, right? You buy in the morning, you've been following this particular stock, it seems to have this kind of a pattern you've detected just with your eye test, just looking at it for a while, studying a stock and its pricing, and you see that it sort of tends to go back and forth in price. It starts low, goes up, then goes back down. If you've captured, then you can simply use that as a way to make some quick money. You buy low and you ride it up for a few hours or a day and you go to that high point and you sell out and you come back and you take your money and you play that game a few times and then you move it to some other strategy. Find out some other stock and do it. For those kind of strategies, limit sell makes perfect sense. But if you are a long-time holder and you think that you believe in the stock and the stock is going to make money, but it does go through some gyrations, then a stop loss is a better way to go because that way you keep yourself open for all future gains. The other side of the equation is your money is also tied up in that, right? You can't free that money and put it somewhere else because it's already in that investment. So depending on what you are trying to accomplish will drive whether you choose a limit sell strategy versus a stop loss strategy, right? Okie dokie. I think, what are we doing in time-wise?
We have 4 minutes.
4 minutes. Okay, let's plow through one or two more. Margin buying. So I want to talk about this, and then we will end. So margin buying and short selling. Margin buying is simply borrowing to buy, borrowing money to buy shares. Right. So you ask your broker. We borrow money to buy houses, for crying out loud. That's what we do. We go to a bank. We save up 10% of our investment, 20% if you're lucky. If we are lucky, and we ask the bank to give us the other 80% of the purchase price, right? We put in 20% down and we borrow the other 80%. And the bank makes us believe that we own the property, makes us feel good that we are a homeowner. The truth is we are not. The bank owns the title, right? The bank just wants us to believe and feel good that we have a homeowner, and we check off, homeowner, yes. Well, if you have a loan, I've got news for you. You really don't own the house. Because if something happens, the bank will foreclose on you in a heartbeat. And then, try to get you out of there as quickly as possible so they can sell the property. So the point is that we borrow money all the time. We don't realize it. We do this all the time. We buy, get a car loan. We buy, finance a car. Those are nothing but, so why can't we borrow to buy shares, right? So we do. And buying on margin is simply asking your broker for a loan. You have to do the same credit approvals, and you get money, and you at some certain interest rate, and you borrow. Now, the US has a rule. You cannot fund more than 50% of your purchase by borrowing funds. So the maximum you can borrow is 50% of your investment. So if you are buying buying shares worth $10,000, you can borrow at most $5,000. The other $5,000 has to be your own money. Now, with the home ownership, on the other hand, we can, 80%, we can borrow 80%, you have 20% down, sometimes even 90%. But that's because it's for a different purpose, you have a whole different discussion, we will have that another day. So buying on margins is nothing but borrowing money to buy shares. All right, I will stop here.